Happy Wednesday, guys, and thanks for joining me for your first time home buyers. I just wanted to maybe wait another second or two. We have a couple more people that should be joining us, but I'm really excited to tell you guys a little bit more about the process. If you don't already know, or kind of give you some tips and tricks along the way for that home purchase that you guys are going to be having. Okay, so we'll start. So a little bit about myself. My name is Gisèle Levasseur. I'm an RBC Mortgage Specialist, and I've been at RBC now 4 years. Before that, I worked at a brokerage, and I am a graduate from St. Clair College. I went to school originally for marketing, worked a little bit in non-for-profit, and then now in mortgages. So one of the reasons why I really wanted to do this presentation with you guys is because I purchased my first home about 4 years ago, and I found it to be a very stressful process. And when you're buying your first property, it's supposed to be an exciting time in your life. And unfortunately, I think I was more stressed than I really was excited. And it all happened very fast. So I wanted to kind of set up expectations, as well as give you guys some tips and tricks along the way for purchasing your home, so it's more of an exciting experience and it's a little bit less stressful. I always find that people kind of give you tips of information along the way. So whether it's your parents or friends or this or that, but they made a purchase their home many years ago, so things might have changed. So that's really why I kind of wanted to talk to you guys today a little bit more about the process, and just to let you know a little bit more accurate information in today's world. So what are we covering today? So you're going to be covering a little bit more about what you guys can afford, about the process in general, some terms, some terminology, as well as taking a look at your full financial picture, right? So it's not just about getting you in the home, it's about keeping you in that home and the ongoing expenses with that people don't really realize, right? So buying your home is definitely an emotional roller coaster, right? From the minute you look at homes online to walking into a home, you're already envisioning how you're going to be living in that property, right? How are you going to celebrate your first holiday? How you're going to paint the walls? What room is going to be what, right? But you really don't take into consideration the financial aspect, right? A lot of people look at the emotional side first and then look at the financial aspect after, right? But it's really the kind of the role reversal. You should actually really figure out what you can afford before you're actually going in to purchase that home. So when you're doing pre-qualification, or even looking at any of the tools, because there is a lot of online calculators and things like that, what you really should be looking at is what's the max and what is your comfortable with your monthly payment, right? So maybe you can technically afford $500, right? That might be your purchasing power. But if I go to tell you that your payments are $3,000 a month and you just about have a heart attack, maybe that's not exactly what you want to do, right? So maybe you want to go back and see, okay, my max payments that I feel comfortable with are $2,000 a month. So let's backtrack that way, right? So you don't always have to hit the max. It's really what you feel comfortable and what other things happen in your lifestyle, right? What other expenses that you may have ongoing that, you don't really think of, right? So definitely an emotional roller coaster. It's supposed to be a fun one, and it definitely is a fun one, but just setting up expectations, especially on the financial side. So RBC does have a few tools and tricks that you can use. We have a rent to buy calculator, as well as a home buying readiness quiz. Now, all these are online, and I can send them after the presentation to you guys. Now, keep in mind, these are just tools. So they're not going to give you dollars and cents. I really still recommend talking to, myself and going over everything a little bit more in depth, but it does kind of give you an idea of, if I were to spend this much money, my down payment is this, kind of what's my, let's say, my monthly payment, and it gives you kind of an idea, right? And that's really what they're here for, is to give you an idea, but you should still definitely speak with a mortgage specialist. So different types of mortgages, and really it comes down to your down payment. So I usually tell people there's 2 different types of mortgages that you can get, and really they depend on your down payment. So as low as 5% is what you can put down, up to whatever you wish. So whether it's 20, 30, 40, whatever the percentage is. Anywhere between 20% and 5%, you're considered a high ratio mortgage. So you're going to fall under this category right here. So you're going to put a lower down payment. And really the difference is the home insurer tax on another percentage. So when you're thinking about it, it's going to be your purchase price, subtract your down payment, and that equals what your mortgage amount is. And then they tack on another insurance premium, depending on really what your down payment is. It could be 4.5% on top of that. Now, we don't expect you guys to pay that back right away. It just gets tacked on to your mortgage. So you don't really notice it, but it is kind of in the breakdown of how we got to that final mortgage number. Now, a conventional mortgage, on the other hand, is anything over 20%. And that's going to be your purchase price, subtract your down payment, and that gives you exactly what your mortgage amount is going to be. As a first-time home buyer, you're absolutely allowed to put 5%, and you can always put up to 20% as well. It really just depends. I like to tell my clients, don't always put all your money in your down payment. Only because you may want to do things in the future, right? You may, depending on the property, you may need a new roof. You may need some new windows. You might need to buy some furniture, right? So you don't want to have all your money in your down payment and then have no money for anything else, right? You don't want to have your friends over and bringing lawn chairs to sit in your new living room, right? So it's always a great idea to kind of have anywhere between 3 to about 6 months worth of saving in your emergency fund anyways. And then on top of that, keeping a little bit of money on side for the renovations or anything that you wish to do for the home, right? Now we're going to get into a little bit of the makeup of your down payment and really what that's going to consist of. So as a first-time home buyer, you're allowed to pull from your TFSA and your RRSP. Now you're allowed to pull $35,000 against yourself. So really you're kind of borrowing it from you. With the expectation that you will pay it back within a 10-year span. Now, I highly recommend not actually touching the money yourself. Always really speak to your financial advisor or someone with the institution where your money is held, because they're going to fill out a special first-time home buyer's tax exemption. If you go to move the money yourself, then you're going to get a tax bill when it comes to do your taxes at the end of the year. So we definitely don't want that. So definitely reach out to whoever your financial advisor is or where the institution that you have your money is. But you definitely something that you can think of when you're using it for your down payment. Now you can also use money that you already have in your bank account. And if, mom, dad, grandma, grandpa, somebody in your family that wants to assist you as well, they can do a gift. So they can provide you, let's say $5,000. You have $1,000 in the bank already, and then you have some money from your TFSA or RSP. You can definitely add them all together and use all three if you wish. So just some food for thought. A lot of people are like, well, I don't have any money in my bank account for a down payment. But if you're already saving, then it's a good idea to, use the money that you're already saving to begin with, right? So we'll go back here just for a quick second. I think a lot of people are trying to figure out if it's a good time to buy or if they should be buying later. I always find the best time to buy real estate was yesterday, because that's probably when it really was, right? If you would have known different things back in the day or back a couple years ago or even a few months ago, right, you might have done things differently. So being educated is definitely going to help, and being pre-approved is definitely going to help you with those next steps, right? And, maybe renting is a short-term thing for you, and that makes sense right now, because maybe you're still in school or you're moving or whatever the case may be. But definitely kind of having that goal of owning a home in the future. So whether you're ready to buy today or whether you're ready to buy in, 2 years from now, it's always a good idea to kind of see where you stand today, what things that you really need to do to kind of get to where you want to be. Because usually when clients come to me and they think they're ready to buy today, they might be a few months out. They might still need to save more money for a down payment. They might need to work on their credit score. There's just, different things that they may have to do, right? So definitely finding out what your financial picture looks like today is always highly recommended. So knowing how much you can afford. So we kind of went over this a little bit in the beginning, and really how we figure out what your max value is, I would say, is we take your household income. So whether it's you by yourself, you with a significant other, or now lately we're seeing mom and dad helping co-sign as well, just because we need a little bit of extra income in the application. We take the whole household income, we divide it by 12. Then we look at your monthly payments, and that's kind of where you're at. So we take a look at your credit bureau as well and see what you have to pay on a monthly basis, right? So whether it's your credit card, a student loan, a line of credit, these things are not they're gonna determine how much you can afford monthly. So we can't exceed a 40% TDS, which is our total debt servicing ratio. So if we go over that 40%, that's when you become house poor, right? That's when you become, house poor in the sense where you don't have anything to live off of: groceries, gas, your regular expenses, right? So if we go to the right-hand side of this column, it's kind of going to go this way. Okay. We're kind of going to go over what you already spent on a monthly basis for your lifestyle, right? So whether you have an animal, a child, transportation, right? People don't think of car insurance, right? That's going to be something, your cell phone bill, your health, right? Do you get benefits at work, or do you have to pay out of pocket? Your regular utilities, food, savings, clothing, entertainment, right? You want the house to kind of go with your lifestyle, unless you're realizing that you're going to give something up to be purchasing this home, right? So that's another reason why you want to make sure the payments are manageable, because whatever your expenses are already monthly, you want them to complement it with what you're already paying, or you want it to kind of go with that lifestyle. So, if you're into a sport or a hobby, you want it to still be able to enjoy your life, but still be able to purchase that home. And we do have another tool at RBC to figure out kind of how much you can afford. And that's really a pre-qualification. So really it's you putting some information in and seeing kind of an idea of what you can afford. Obviously, it's not going to be perfect, but it kind of gives you a rough idea. And that's where I would suggest sitting down with me and kind of let's review your full financial picture and kind of see what you have your monthly expenses already, or what things that we should be paying off before we kind of get into that home. So we'll move back to this side. So there are a few things that are one-time costs and then ongoing costs with the home that really people don't really think of, right? So, a lot of people are like worried about their down payment, but you should still have some extra money on the side for anything in the future, right? So a couple things that people don't realize, lawyer fees and closing costs. That's usually I usually tell people budget $1.5 grand. So the lawyer is going to need to be pulling titles and different documentation that way. Those are kind of one-time fees. Unless you purchase another home, then you're going to see it again. But have some money saved for that, right? Home inspections are great right now. They look at kind of the bones of your home, the things that you don't really look at when you're looking at it. So that's definitely something highly recommended when purchasing your home. Moving costs. Are you calling some friends and getting some pizza and drinks over and helping people, helping your friends move, or are you going to hire a moving company, right? Land transfer tax is an important one. As a first-time home buyer, you are exempt from land transfer tax. So that's the one-time thing. If you're purchasing from home A to home B, then you're going to have land transfer tax on home B. And the amount of land transfer tax is the purchase price. So depending on what that purchase price looks like. Title insurance, that's part of the lawyers. And then utility hookups, right? So City of Windsor may charge you $75 to hook up your utilities, right? So just the one-time things that I always tell people you should save. The rule of thumb is 4% of your purchase price is really kind of what you should have saved for that. Now, ongoing costs. So things that are going to be happening on a regular basis, on a monthly basis. Mortgage payments. RBC does not include property tax in your mortgage, so that's going to be paid separately. It actually benefits you as a client opposed to rolling it in, because any institution will pay for it twice a year opposed to you paying it, let's say, on a monthly basis. So for example, City of Windsor, they exempt you from January and December, so they charge you for those 10 months. But you get to pick and choose kind of when you decide you want to do it, whether it's quarterly or you want to do it on a monthly basis. Where RBC or any institution will collect about 6 months worth on top of that. So I don't know about you, but I rather, my money be in my bank account opposed to giving it to somebody for them to make interest off of it, right? So it's just really beneficial for you to kind of keep those things in mind. Another thing, if you're in a condo or townhouse, you're going to have condo or maintenance fees. That's something that's not included in the mortgage. That's going to come out of your bank account as well. Homeowners insurance, right? So anything with your home, utilities, your regular hydro, gas, water, and then any additional services. So phone, cable, internet, Apple subscriptions, Netflix, things like that, right? That are included. Those are going to be ongoing costs for your home. So finding the right mortgage that works for you. This slide sometimes can be a little bit much, but I'll break it down. So really the big thing in the news right now is fixed versus variable. And I usually suggest as a first-time home buyer, you might want to go fixed because you're going to be able to know your payments every single month. So they're not going to change for the length of the term that you pick for your mortgage. So if you decide that you want a 5-year mortgage, they're going to be, let's say, $1,000 a month every single month for the next 5 years. Now on the variable side, and this is where it kind of gets in the news lately with the Bank of Canada, variable fluctuates with the Bank of Canada. So every time they raise their interest rates, your rate, your monthly payment may potentially change, right? So I usually tell people, if you're a gambler, variable might be great for you. If you're more on the safe side, fixed is really more beneficial. Now, historically, variable is lower than fixed. But currently right now, variable is higher than our fixed. So amortization, we don't expect you to pay it back in 5 years. That'd be ridiculous. You'd have no money for anything else, right? So we break it over a 25-year span. And really what that means is it helps you make your monthly payments on more reasonable payment every single month or week or however you decide to do it, right? Now, if you are doing a conventional mortgage, you can break it down over 30 years opposed to 25, but you can always do less than that. The term really, and that's going to be your interest rate, depends on, I usually tell people what your goals are. So you can do a 6-month, you can do a 1-year, 2-year, 3, 4, 5, 7, or a 10-year term, and that's going to be what your mortgage rate is going to be for that period of time. So let's say you're doing a 5-year fixed. Your 5-year fixed today is going to be 5.69, and that's going to be locked in for the next 5 years. So no matter what happens with rate, that's going to be your rate for the next 5 years. So hypothetically, let's say if rates go to 8%, for instance, you're still locked in at that amount, right? Because you're doing fixed, your payments are not going to be changing. And so when you're looking at a term, I always tell people, don't go what the best rate is, go with where you see yourself. So my best rate might be 5 years, but if you tell me you're going to be moving to Calgary in 2 years, a 5-year really does not benefit you because you already know that you're going to be moving in 2 years from now. So why would you sign up for a 5-year, right? Maybe a 2-year mortgage might work out a little bit better for you because that just makes more sense with where your goals are, right? And these are something that you don't have to decide right away. I usually tell people you kind of have an idea once you see the home, right? So if it's a starter home, you're like, oh my God, I'm only going to be here 2 years for sure. Don't sign me up for a 5-year. Then 2-year might make more sense. But if you say, yeah, for sure, love it, it's my dream home, I'm really not going to be moving anytime soon, then maybe 5 years is really where it's at for you. Now, term type is open versus closed. So an open mortgage basically means that you're not making any commitment to RBC or any institution, right? You can take the money for your mortgage, you can pay the whole thing off tomorrow, and there's no penalty for you. Now on a closed mortgage, your rate is a little bit lower, right? So now we're looking at the 5.69. If we're doing an open mortgage, your rate might be 10 or even higher, right? Because there's no commitment there. Now, the closed side, if you are breaking that contract, right? So let's say you signed up for a 5-year and you leave 2 years in, you're going to have a penalty to pay. And that penalty really determines the interest that we would have collected off of you in that time frame, where rates are at, how much you have left on your mortgage. So there's multiple different factors on that front. So there's not a specific number that I can really give you, right? But that's where I tell people knowing where your goals are is going to help you with that, right? So if you know you're leaving in 2 years, a 2-year term might be better for you than a 5-year. And then all of a sudden you have this penalty, right? So I wouldn't be doing you guys a service if I said, yep, sign up for a 5-year, it's a great rate. And then you told me you guys were going to move. And then all of a sudden now 2 years in, you're like, what the heck's this penalty, Giselle? You didn't tell me about this, right? So go with where your goals are is really kind of the message at the end of the day. You can always sign up for a 2-year, you stay another year, you decide not to move, sign up for another 1 year, right? So you do have some flexibility that way. Now, payment frequency. So sometimes people like the monthly aspect, especially if you were renting. Monthly might just work better for you. First of the month, you paid your rent. first of the month, you might want to just pay your mortgage, right? Get it out of the way. But some people like semi-monthly, bi-weekly, weekly, and then accelerated payment. So it depends on how you get paid. And I always tell people, make sure not everything comes out at once, right? So if you have a student loan and a car payment, right, and then your mortgage, you don't want to have everything come out that week if you get paid semi-monthly or bi-weekly, right? Because then you don't really have any money for the rest of the month kind of thing, right? So kind of figure out where your paycheck lies and then what other expenses come out as well. So amortization, we kind of just covered this a little bit already. So your amortization is really how the length of the mortgage term you're going to have. So how to kind of pay it back a little bit faster. And then term is kind of where you're going to hold that rate for. Now, when we sit down and you guys do those calculators, you're really doing kind of what I call a pre-qualification, right? So you're kind of putting the information in and it's spitting kind of it's a number back, let's say, right? Now, they're not accurate fully, so they are just an idea. So that's where I recommend doing an actual pre-approval. And really the difference between a pre-approval and a pre-qualification is the pre-approval, we're actually locking you in for a rate for 120 days. So you have 120 days to find a property. We lock in that rate. Let's say you exceed the 120 days and don't find anything. We can either re-rate commit you, or you can say, Giselle, you want to know what? I haven't really found anything this fall. I'm going to try again in the spring. Let's just reconvene in the spring and let's do another pre-approval then. It doesn't cost you anything to do a pre-approval. So I always tell people it benefits you in the long run, because if something comes up and you find your dream home, then you can definitely jump on it, right? So I always ask clients for some documents up front when we're doing a pre-qualification and also a pre-approval, because that way we can use actual real numbers, right? If you were to say, Giselle, I think I made $46,000 last year, and then I look at your T4 and your T4 is 40, that's a big discrepancy, right? That could change the value of what you're purchasing. So real numbers is always the best. So when I'm looking at documents, we're looking at your recent pay stub. We're looking at your T4. If you've been at a new employer less than a year and you don't have a T4, we look for your employment letter. So you have to be on the job for at least a minimum of 3 months or off your probation period. Now things would change too. Your documents would change a little bit. Let's say if you were self-employed or seasonal, that's something else that we can definitely discuss as well. But typically we're looking at pay stub and T4. If you work in the States, W-2, we take a look at your net worth. So what other savings do you have, checkings, investments, asset, things like that? And that really takes a look at what you can afford. We also take a look at your credit bureau. And your credit bureau, not a lot of people always look at theirs. So if you're with RBC, I believe CIBC, and a few other maybe institutions, you can check it yourself. Now, I don't recommend checking it every day. It only updates once a month, but it's definitely something to keep in mind. So a good credit score is anything above 650. The highest is 900. It is literally a unicorn. So if your credit score is not 900, don't expect it's not bad. But really the importance is looking at your paying history, right? So how good are you at borrowing money and paying it back? So for instance, if you have a credit card that's $1,000 and you're not good at making your payments on time, why would anyone want to give you $100,000 to help you with your mortgage, right? It just really doesn't make sense. A lot of people also, and this would be a tip, is your cell phone shows up on your credit bureau. Most people don't realize that. So the amount of, TELUS or kudos lates I see. And what you really have to consider as well is when you're paying your mortgage, or when you're paying, your cell phone bill, let's say your bill is due tomorrow and you paid it today. Technically in your eyes, you're not late, right? Because you paid it on time. But it does take 2 to 3 business days to get to that other institution's bank account. So in TELUS's eyes, for instance, you technically are late because you didn't pay it on time, right? So a tip would be if your cell phone due is, your cell phone bill is due tomorrow, maybe pay it on Monday. By the time your cell phone bill actually is due, it'll be in that institution's account, right? So that's just one trick. Another thing is, let's say you've exceeded holiday season is coming up, so this is the worst time to pull someone's credit bureau. But let's say you exceed your payments. So you can't, let's say you have a credit card and you max it at 1,000 and you don't get your Christmas bonus until the end of December, right? Make the minimum payments at least. So if your minimum payment on your Visa bill is, $20, make the $20. That way you're still in good standings with your credit bureau. I always see so many lates or disputes, and it doesn't help you as the consumer. It kind of hurts you in the long run, right? So that's just a little bit of a tips and tricks for your credit bureau. So there's a whole team that goes into purchasing your home. It is not just myself. I usually tell people I'm the first step, but there is a great team along that we work with really closely. So one of the teams I work with is with RBC. So we take a look with our investment planners. We take a look with our financial advisors, what the best financial picture looks like for you, if there's anything that we need to tweak or help along the way. Then we work really closely with your real estate agent, right? So once you're pre-approved, I provide them a letter that says, yep, Johnny has been pre-approved with RBC. This is his max amount, right? So that's really what your real estate agent is looking for, right? They want to make sure that you did your due diligence so they can do their due diligence as well, right? Because it's really pointless for them to show you all these houses that you may not be able to afford. They help you write an offer, and then all of a sudden you realize now that you could only afford $300,000, but you were looking at $600,000 homes, right? So working really closely with the real estate professional. Having a home inspector as well, right? So they have the best interest at heart for you in terms of the things that you really don't think of or the backbones of the house, right? As well as your lawyer. So this is your power team that works really closely together to kind of get the job done, start to finish, and help you get into that home. So the goal at the end of the day is to be mortgage free. So usually when clients are like, oh, I don't need a mortgage, I paid my mortgage off, I'm like, high five, congratulations. That is the goal at the end of the day, right? So one of the ways that you can pay back your mortgage faster, and I don't expect clients to hopefully pay back in 25 years, hopefully you can pay back sooner, right? Is doing double up payments or anniversary payments. So what a double up payment really is let's say your mortgage payment a month is $1,000. Every month, you can do an additional $1,000 on top of that. The additional money that you put down goes right towards the principal and not the interest. And really what that means is the bank, RBC, will make less money off of you because you're paying it back, right? So the longer that you take to pay it back, the more interest we collect off of you. The shorter amount of time, the less interest, right? Now, you don't have to do the $1,000, right? Let's say you only have $50 a month extra, right? Or, you want to decide which months you want to do it, right? So realistically, most people don't do double up payments in December. It's the holiday season. January, you're getting your Visa bill, probably not again there, right? Maybe February, you might start again, or maybe the summer. So you get to pick and choose when you want to do it along the way. And you don't have to do the $1,000. You can do $50. You can do $20, right? Whatever you want to contribute, as long as you're not exceeding your monthly payment or weekly payment or bi-weekly payment, whatever your payment is. Now, the large lump sum you can do every year is 10% of the original mortgage balance. So for instance, let's say your mortgage is $100,000. 10% of that would be 10 grand. Every year on the anniversary, so the closing date of your mortgage, you're going to put $10,000. Now, you don't have to. You can if you want. It's great if you do. If you don't, not a big deal. Some people decide that it's easier for them to save and put a large lump sum than do the double up payments. If you want to do both, even better, more power to you. But you don't have to do the full 10%. You could put $1,000. You could put 1%. You could put 5%, right? Whatever you wish to do, but it just helps you pay it back faster, which means less interest collected over time. Skip a payment is an option as well. So let's say there are hardships and a lot of people decided that they wanted to do a skip a payment during the pandemic. Some uncertain times, paychecks weren't coming in necessarily, right? You kind of were off for work, whatever the circumstance was, you can skip one mortgage payment. So let's say, for instance, your payment came out in October. you have a hardship right now, you're going to skip your November payment and then restart again in December. Now, skipping a payment does not mean that you never have to pay. They just put it at the back end of the mortgage is really kind of where it goes. So you're still paying for it. You're just not paying right now. That's all. So a little bit of what we've covered today is really knowing how much you can afford, giving you some food for thought on thinking about what other expenses that you have plus a mortgage, right? Buying your first home, helping you pay it back sooner. You don't want to retire and use your retirement savings to pay your mortgage payment, right? So hopefully the goal is by the time you get to retirement, your home is free and clear, and you can use your retirement savings to go to Florida, go on vacation, wherever the case may be, right? So this is just a few tips and tricks just to kind of help you out along the way. I really don't find that you get education for first-time home buyers really anywhere. No matter what you went to school for, whether it's a doctor or a dentist or in the automotive industry, right? They really don't teach you some of kind of the fundamentals of life, right? And having a credit bureau, buying your first home, paying your taxes, setting up a budget are really some of the fundamentals that you really need to kind of move forward in life. So that's one of the reasons I really wanted to do this presentation today with you guys, was just to help educate you guys a little bit better on the buying process and kind of what things that you should be expecting or starting to save for. So I will leave it for any questions right now. Obviously, if you don't have any questions or you want to go over something personally, you have my contact information. You can reach out to me at any point in time. I'm pretty easy to find on most social media platforms. But I will just see if we do have any questions in the box. I don't believe so right now. But I thank everybody for coming tonight, and I will definitely follow up with you guys if you do have any questions or would like to book a personal pre-approval or pre-qualification appointment. I'd be happy to set that up. You can always go to my Instagram and book yourself an appointment right online. And I hope you guys got some value out of tonight, and I'd love to know your feedback, and I hope you guys have a wonderful evening, and thanks for joining. Oh, we do have one question. Okay, so one question is, I'm a bit confused on the difference between the term and the amortization. Can I have a 30-year amortization with a 5-year term? So the answer is yes. So what your amortization is really breaking down your payment. What your term is keeping that rate. So your rate for 5 years is going to be different than your rate for 4 years or your rate for 3 years. That's the term. The term is really the rate and how long you're keeping it. Every mortgage in Canada is pretty much usually amortized over 25 years. Especially if you're putting as low as 5% down, you can't exceed a 25-year amortization if you're putting less than 20%. If you're putting over 20%, then you can go over 30. Really what it's doing is it's just helping you make your monthly payments a little bit lower. So hopefully I answered that question for you. I don't see any other questions right now. So I will end the webinar here, but I really appreciate you guys for joining tonight, and I hope you guys have a wonderful evening. Thank you.